Hi everyone, I'm Joseph Tan. Welcome to Basic Business Finance. Today's topic, Structure of the Financial Statement Part 2, Lecture 2, Part 5. The objective here for you, here in point 3, is to identify the user of information, financial information. Point 4, describe the types of business organization by ownership. We'll touch on 2 points here. Point 2, users of financial statement. There's one. And point 3 is types of business organization. A lot of people use financial information. Okay, there are many people, different types of people, and all used for different purposes. We'll look into them. Generally, there are probably four main users here. Okay, the four users of financial statement. These are the four main types. We have this credit grantors, basically the lenders. Next, investors, management, and others. Credit grantors, basically lenders. Example with the banks and financial company. This you are familiar with. Suppliers is a supplier of what? Supplier of goods. Is in the business, it's normal for one supplier to supply goods to a company. For example, Bread Talk. Okay, Bread Talk buy let's say flour from supplier. They don't pay cash. Sometimes they do not pay cash immediately. They pay 30 days later. So in some sense, the supply grant Bread Talk 30 days credit here, right? So basically, in some sense, it's lend, okay, but with a very short term type of loan, 30 days only. Next, you have bondholders. So basically, you may ask, so what is bond? Okay, bond is basically a type of debt instrument issued by company. Okay, so company issue debt instrument basically is to borrow money from others, right? Next, we have investor, the shareholders, or even potential investors, okay, which want to invest, who are invested in company and want to know how well the company is doing, okay, or potential investor deciding whether to invest in the company or not. Next, you have management, the chairman, directors, and managers. They need information to manage the company, of course. Without all this financial information, they will not they cannot make a good decision. So basically now, smart management will make that decision based off as much information as they can. I mean, relevant information they can get. They have others like auditors, okay, to audit the company. Okay, employees. Sometimes employees want to know whether the company is doing good. If they're doing good, will they get more bonus this year? And government know how much to tax on the company. There are three common forms of business organization. We'll touch on the three common forms here. Okay, we have companies, partnership, and sole proprietorship. So for companies or corporations, okay, is a legal entity that is registered under the Company Act. This is the most important type of business organization here. Okay, so owners are called shareholders, okay, and have limited liabilities. Limited liability basically means loss are limited to the investment. It basically, let's say you invested $10,000 into this business. So if the company ever go bankrupt and still in debt, okay, your limit is only up to 10,000 that you invested. That's it. Shareholders may receive periodic return from distribution of profits called dividends. So when the company do well and decided to reward the shareholders, okay, they will give out dividends, okay, to the shareholders. So for public companies, the number of shareholders is unlimited. So they can have thousands and thousands of different shareholders, okay, for a public company. Partnership is governed under Partnership Act. So basically governs the rights and duties of a partnership. A business firm formed by 2 to 20 partners to run a business for profit. If it's more than 20 partners, the partnership must be registered as a company under the Company Act, except for certain professionals. It has unlimited liabilities. Basically means that the laws are not limited to their investment alone. They may lose their personal wealth in addition to their investments. So the return they make from here is basically the profits are shared. The profit made from the business are shared among the partners. So proprietor is the simplest form of business organization. The business is owned by only one person. The owner has unlimited liability. Losses are not limited to his investment alone. He may lose his personal wealth in addition to his investments. However, the returns, all profits are belong to the one owner. We have come to the end of this section. Thank you for listening to me. See you soon.